When you hear that saying, the equity market is not the economy, I don't think there's a better illustration than what we saw in the third quarter of this year. This is Megan Horneman, the Chief Investment Officer for Verdence Capital Advisors. We're coming to you today to give you a review of what we've seen in the third quarter, as well as what we see as our year-end outlook for not only equities, but the economy, the fixed income market, and alternatives. But let's dig right into what happened in the third quarter. And the economic data that we received for the quarter was very mixed. We saw a labor market that was weakening substantially, manufacturing that was challenged. We even saw the housing market that really couldn't get onto a solid footing. But what we did see, and why the markets really cheered this, was that there was some thawing in the trade negotiations between some of the key trading partners. And also the market started to take that weak economic data as a sign that the Fed would be able to resume interest rate cuts this year. And that's what they did end up doing in September. But let's look at this chart and break down the returns. As you can see, we saw a rotation out of that large cap growth area of the market into some of those areas that have been unloved, that can benefit from interest rate cuts. Looking at the Russell 2000, value, growth, the 2500, these are your small and mid cap stocks. They outperformed the S&P 500 and the Russell 1000. Internationally, you can see that China finally turned around. This had a lot to do with the fact that the U.S. and China started to talk from a tariff perspective. When you get into the fixed income market, you had pretty solid gains here in the U.S. for fixed income investors. You looked at emerging market debt, benefited from the dollar rebounding, but also the riskier areas, high yield. All of these areas of the market rallied because of the Fed's rate cuts. Now, municipals have been challenged for a year now, but they benefited from not only the rate cuts, but also less supply. So those bonds did well. When you look at duration, the short duration bonds did were a little bit weaker than the longer duration bonds. And again, that's a weaker economy, and Fed rate cuts tends to lead to lower yields. In the commodity space, in the green, it was all precious metals. You look at gold that continued to make record highs with the inflow that we've seen from an ETF from a retail perspective, the central bank buying. It really benefited the precious metals space. The dollar got a little bit of relief here with the fact that the Fed's going to come in, stabilize the economy, and that the U.S. was working through some of these tariff negotiations.